Good morning, traders. Let's discuss the morning market analysis and discuss what is the impact of reciprocals of Trump on US dollar, crude oil, and gold. The US dollar index fell sharply on Thursday, approaching the 102 range during the North American session. The dollar continued to slide as US President Trump announced Liberation Day tariffs, which led to increased investor concerns about slowing economic activity. Technical indicators also added pressure with multiple key moving averages pointing to further downside. The US dollar index plunged in European trading on Thursday, having retraced almost 75% of the Trump rally since October last year. Weakness in risk assets dragged it below 102 and at one point saw a low of 101.27 since September last year. This came after President Trump confirmed the implementation of broad tariffs on global imports. The initial surge in yields and volatility gave way to a more cautious tone, with details showing a 10% general tariff and an additional 25% tariff on imported cars. China's tariffs are now almost 60%, the European tariffs are 20%, and there also is a baseline of general tariff of 10%. Given that these tariffs are presented at a discount rate, they are also likely to be increased in the event of retaliation. The danger of a global trade war remains, so the market does not see a rebound in risky assets, thinking that all the bad news has already appeared in the front of it and the situation has become extremely bad. From a technical perspective, the US dollar index once fell to near 7-month low of 101.27 and faced downward pressure running between the support level of 101.00 and resistance level of 103.00. The 14-day RSI of the technical indicator of the daily chart fell to the oversold zone near 26.37, so it is prudent to wait for some short-term consolidation or a modest rebound before preparing for the continuation of the continued strong downward trend. However, the broader setup seems to be firmly in favor of bearish traders and suggests that the path of least resistance for the dollar index to fall is downward. The moving average divergence situation remains bearish, with 20-day and 50-day short-term simple moving averages pointing downwards, further strengthening the resistance ahead. The first key level to watch in the short term include 102.53, which is 76.4% of Fibonacci retracement of 100.16 to 110.18, and 103.00 resistance areas, while challenges below may further point to 101.49. Uh, so the which is 61.8% Fibonacci retracement of 93.28 to 114.78, and 101, which is the round mark. Unless bias captures the area above 103, today consider shorting the US dollar index around 102.08. Stop loss will be 102.2 and the target will be 101.6 or 101.5. So let's talk about crude oil. So on Thursday, 27th March, international oil prices rose slightly as market participants were evaluating the impact of tightening global crude oil supply and the latest US tariffs on the global economy and energy demand. The intraday decline was more than 5.8%, the largest single-day decline in nearly a month. Market sentiment was suppressed by multiple negative factors. Under the resonance of short-term technical and fundamental factors, crude oil prices entered a weak pattern. Crude oil prices continued to slide from the previous day's pullback near $72 and attracted a lot of follow-up selling during Asian sessions on Thursday. However, the commodity found some support near $66 and is currently trading in the $66.3 area, still down more than 5.8% on a day, building on the bearish report released by US Energy Information on Wednesday, which showed that the US crude oil inventory unexpectedly increased by 6.2 million barrels last week. This has become a key factor suppressing crude oil prices, although Trump's new tariff measure have not yet affected North American crude oil trade. The impact on the global trade system may weaken crude oil demand and put pressure on oil prices. The market still needs to pay close attention to the Fed's policies, OPEC's decisions, and global manufacturing data to assess the further trend of the oil prices against the backdrop of rising global trade uncertainties. Oil prices may remain volatile in the short term, while the long-term trend still depends on the outlook for global economic growth. On Thursday, crude oil prices once again fell below the psychological level of $70. Crude oil is currently trading around 66.4 per barrel, and oil prices are facing some downward pressure in the short term. It may initially retreat to $100 per barrel. The temporary top may have encountered obstacles at the 200-day simple moving average of $72. On the other hand, the 14-day RSI of the chart indicates plummeted to a negative zone near 39.58, and oil prices may continue to fall with tendency to extend further in short term. The expected downside target will be $66 and then 65 dollars March 5 low. On the upside, the first resistance is 68.65 and 68.65 and 68.82, which is a simple moving average of 14, and then $70, which is a market psychological level. So you can consider going long on crude oil near 66.18, and stop loss will be 66.05, and target will be 67.5 or 68. Let's talk about everyone's favorite, which is gold. Gold prices fell more than 1.25% on Thursday, hitting a low of 3054. Traders are taking profits, pushing gold prices below important key levels. It rebounded again near 3114 at the close. The market saw all asset classes digesting the shocking announcement of US President Trump implemented a reciprocal plan for the world. Gold prices corrected in European trading have earlier hit a record high of 3167 in the early Asian session. Traders are cashing in some of their profits, sending the precious metal price down to 3054 at one point. Traders are still pondering the implication of this announcement, which is a minimum standard of 10% global based tariffs, which applies to any country importing to the US. From then on, all the other earlier imposed tariffs remain in effect, meaning that, for example, the total tariff on China is 54. From this Thursday, the market is seeing safe haven inflows. Global liquidities are down multiple percentage points. Bond yields are falling. Bonds are in demand, and the dollar is depreciating against all major currencies. Gold prices saw a logical turn on Thursday, and the dust settled on the Trump administration implementation of reciprocal by the rumors that the fact is a traditional trade adage in the market that is currently playing out, with possible negotiations and deals between the US and the countries to circumvent Trump's tariff. Sentiment can improve from here, which means gold prices will soften. Conversely, if countries started issuing retaliatory tariffs, gold price could rise further with new all-time highs forecast. On the upside, intraday resistance is at 3116, which is the 5-day moving average, is the first level to recapture, followed by Monday's high of 3128. Beyond that, larger upside targets are 3143. On the downside, 3073.70 is the first support level, and further downside support at 3078 should ensure that gold does not fall back below the psychological level of 3000. Consider going long on gold before 3110 today. Stop loss could be 3105, and target can be 3130 or 3135.